So good morning. I'm delighted to welcome you to the Babraham Research Campus and to PEM's 2025 budget seminar. It's great to have such a good turnout. And I hope those of you who jumped in your electric cars this morning, left your £2 million plus mansions to be with us aren't feeling too put upon. So first, just a little bit of housekeeping. No fire alarm testing has been planned. So if you do hear the alarm, please through the doors here, down the stairs and out at the front of the centre. So I hope you've had a chance for a chat, some coffee and some breakfast. I'm pleased to say the speakers this morning and our tax team will be on hand to answer any questions you have at the end of the event. So we do have quite a tight timetable. We're working towards a 10 o'clock finish for the presentation. And we do have some time for some Q&As. So please do use Slido. So you'll see the screen behind me, either use a QR code or log in that way to ask any questions. The QR code is on pretty much every slide. So if you miss this one, don't worry, there's time for it. So a budget of stealth, stability, and the stick. Quite like that as a title. And I think we probably have to start the session by saying, Rachel, what were you thinking? Holding the budget on the same day as steel budgets. It's just not good. So please check with the Cambridge professional community before you lock down next year's date. PEM's tax team took the right approach, spending the afternoon with clients, contacts and referrers at the rugby and whisper it, sorry guys, maybe a bit more interesting than the budget. Who knows? And I'm also very pleased that unlike the OBR, this presentation wasn't leaked 45 minutes ago, but that was too easy, sorry. I think we'd all agree that delivering a budget would be a pretty tough gig. I don't think any of us would fancy that at all. Balancing support within your political party with maintaining some economic credibility, open to question, and trying to persuade voters that you actually know what you're doing. And all that without upsetting the Daily Mail. It's a tough job. I was reflecting when the government came to power, which I think was about 18 months ago, there was a lot of positivity around the Chancellor. Some pretty, that sounds painful, who's out there. Some fairly business-friendly policies. The manifesto seemed to make sense, and there was apparently a laser-sharp focus on growth. And the markets trusted Rachel. Over the past year or 18 months or so, the markets still seem to trust just about. The rest of the country, the goodwill seems to have disappeared quite rapidly. So, did the budget announcement on Wednesday restore some of that goodwill? We all have our own opinions, no doubt, but only time will tell on that. So I'm under very strict instructions not to steal the thunder from our speakers, which apparently I do every year. So I shan't for the first time. What I can say is that for Cambridge's entrepreneurial community, there is good news. We all know that the UK's ambitious researchers, innovators and entrepreneurs are a driving force of economic growth and job creation across the UK. There are positive changes to the Enterprise Investment Scheme and the Venture Capital Scheme, which will help reinforce Cambridge's reputation as a hub for innovation. And as Rachel Reeves said, this is about helping startups scale up and stay in the UK. And of course, it goes without saying that at PEM, we're with you for every step of that journey. In terms of local developments, there was a reminder of the 500 million investment in the Oxford to Cambridge corridor, which was announced at the spending review last month, with a focus on infrastructure and planning priorities. The Chancellor also reiterated the government's support for the East-West Rail link. I'm sure you've all digested a fair bit of this budget since the announcement on Wednesday. But to bring all the important points together, I'm delighted to introduce Jan Fasho, Stephen Bartlett-Rawlings, and Sancha Norris, who will be guiding you through the highlights and possibly some lowlights from the budget. So Jan, over to you.
Thank you very much, Warren. Yes, no, I think Wednesday was definitely not the best day to host a budget. I was worried more about getting an extra ticket, which thank you very, very much for someone in the audience for arranging that. So whilst we were having our lunch, we could see the BBC announcements coming through, and then as part of the dessert, it was looking through the 251 announcements in the budget booklet was having a chat with various people before the game. So in terms of, there was 251 measures. I think we mentioned that really it was trying to unpick those measures and reading between the lines. There was a lot of stealthy measures coming through. A lot of talk about stability, time will tell, and definitely there was a lot of stick in lots of the measures as well. So I think they also they're looking to raise an extra 26 billion pounds of additional taxes on top of the 40 billion from last year's budget, so 66 billion in the last 2 years. So hopefully today, my aim is to really cover what's changed, what it means to everyone in practice, and what you can do in terms of businesses and also as advisors as well. So today I'm going to cover three separate segments: corporation tax and capital allowances. I'm going to move on to business exits. There were some announcements in relation to employee ownership trusts and also some welcome changes in relation to employee incentives in the EMI scheme. And third and finally, we'll have a bit of a session on venture capital schemes, so SEIs, EIS, and VCTs, the good news that Warren mentioned. So in terms of corporation tax, there hasn't been really much change in terms of rates over the last few years. We've had 25% rate on corporation tax and 19% starting rates for profits below 50,000. So that's going to remain for the rest of the Parliament. People still have to be very careful because those limits are divided by the number of associated companies. And also, you have to be careful with quarterly instalment payments as well. So these are things that are mentioned every year. What announcements that has been made is that there's going to be a doubling of penalties from April 2026. And really, that's a clear sign that we've seen over the last few months. There's going to be more interest on the underpaid tax, more penalties, and more consequences for delays as well. So I think something to be careful in terms of compliance. Usual slides in terms of how we are doing in relation to the rest of the world. I've got the G20 here. So the UK is very much middle of the pack. You can see you've got China, France, Russia, Spain, Turkey, United Kingdom, all at 25%. Yes, there are a few countries with lower rates and quite a few with higher rates as well. And I think the main rates of tax is not really the only indicator. It's the tax regime the UK still has, which is really good. We've got generous dividend exemptions. We've got substantial shareholding exemption on disposals, which is becoming very handy with the advice that we're giving at the moment in terms of structuring. Also internationally wise, we've got a very good system of double tax treaties as well, which reduces withholding taxes on cross-border payments. We also have maintained very good generous tax reliefs on R&D tax credits, the patent box, which are unfortunately the last few years been more targeted to UK activities, but they're generally still very, very generous. And also we've got very good capital allowances, which I'll go into a bit more detail next. So yes, the main rate is fairly average, but actually the UK is still very good in terms of tax regime. In terms of capital allowances, I think the main change was the reduction in the main rate from 18% to 14% from 1st of April 2026. The annual investment allowance is still at £1 million, and that's permanent. And we still have the 100% full expensing. But there are a lot of exclusions and various restrictions that you have to be very careful on how you apply these reliefs. These are for new, unused assets, and typically anything that to do with leasing is restricted. Although there are going to be some changes which are welcome as well. We've got another year extension in terms of the first year allowance for zero emission cars and also charging points, which basically will be up to 31st of March 2027. The new 40% first year allowance is not just for corporates, it's also for unincorporated businesses and also includes leasing assets. So we do have a few clients where they've got groups and they might have assets in one company and they might have a trade in the other company as well. And they were caught by the leasing restrictions. So actually the 40% is a step in the right direction. It means that you can still structure things slightly better. And hopefully that's going to change for the better going forward as well. In terms of other announcements, everyone saw the announcements on the Tuesday. So The national living wage is increasing by 4.1% to £12.71, which is an extra £975 per year for someone working full time. For 18 to 20-year-olds, actually the increase is 8.5% to £10.85, which means that businesses employing a full-time person between 18 and 20 is an additional £1,657.50 on the national living wage. So I think for hospitality, for care homes, all of those type of businesses, that's going to add quite a lot of inflationary pressure as well. There were also a few bits in the documentation we had to unpick as well. There is transaction between shareholders. So a lot of owner-managed businesses might have lots of separate companies, and they might have transactions between one company and another, loans and so on. I think that's going to be under a lot more scrutiny, and we have to be very careful how things are being moved around. That's going to be reviewed, possibly reported by HMRC in a bit more detail in terms of reporting it to HMRC. The ATED charge, good news is that you're going to still be able to claim release if your return is being filed late, but the penalties are quite steep as well. So the ATED charge is where people have put a property inside a company which is worth over £500,000. In terms of business exits, there were a few announcements on employee ownership trusts. So employee ownership trusts were introduced in 2014 as part of the Nuttall Review, recommending the John Lewis model. And it was really offering a CGT-free route for vendors to dispose of a controlling stake into an employee trust for the benefit of the employees. And basically that CGT-free amount, instead the CGT base cost would be reduced in the EOT. And one of the benefits as well is you could pay up to £3,600 of bonuses each year, tax-free to employees as well. But that limit hasn't changed since 2014. So the big change really now is that restriction, that CGT-free is actually going to be half. So it's going to go from 100% to 50%. And that's going to really change people's views of EOTs, I think. So instead of having a 0% disposal, actually it's going to be half of the CGT rate, which is 24%. So typically if you're disposing to an EOT, 12% rate of capital gains tax. And when you have an EOT in place as well, where you're putting into it, you can't claim business asset disposal relief. So the difference between 14% currently, 18% next year, and 12% for an EOT are going to have to be things that we are going to look at very carefully as well. I think the EOTs clearly historically has been very good for vendors. It does present some challenges in terms of what you do with the business going forwards. Ultimately, the trust would have to dispose of the shares, suffer that CGT at 24%. Any proceeds being paid to employees would then be subject to income tax and NIC over 3,600. So there was a lot of issues in terms of EOTs and disposing of shares out of EOTs as well. So I think that focuses the mind. So I think when we're having conversations, we often look at what's the best route to exit. Typically, conversation goes along, is it best to have a trade sale? Is it better to have a management buyout? If there is a departing shareholder, maybe doing a share buyback if you've got the cash and distributable reserves, or whether an EOT might be more appropriate. MBOs, I've got an example, very similar principle. You dispose of your shares to an MBO co, and effectively, provided you get clearance from HMRC, you get capital gains tax treatment, and you also get deferral into any shares and loan notes. And the reason I mentioned that, there was an announcement that there's going to be a lot more anti-avoidance and refocus on the share for share exchange clearances as well. So this is an area that maybe people now looking between EOTs and MBOs, but you do have to be very careful. You have to make sure you get proper advice. The vendors need to make a significant reduction in their interest in the business, and you have to go for that clearance. And there are some additional steps that you have to bear in mind now. So that's the point I was just making. So also the other point to remember on the CGT is that business asset disposal relief is going up to 18%. Moving on to other announcements on incentives. There were some very welcome news to the EMI, which is a very good scheme to recruit, retain, and reward key employees, and especially with staff costs going up, that's something that certainly needs to be thought about a lot more. So from April 2026, the scheme is going to be expanded. The amount can be included in terms of EMIs goes from 3 million to 6 million pounds. I think the big thing, I was having a discussion with our employment tax team, I think Matthew Eady, who heads up. So there's been occasions where actually there's been some fundraising tipping over the gross asset from 30 million to 35 million. And that stopped people from doing EMI scheme. That's been quadrupled to 120 million. So that's going to be very helpful to a lot of businesses in Cambridge as well. And also there are some other welcome changes as well in terms of the increase of employees from 250 to 500 employees, and the holding periods increased from 10 to 15 years as well. So that's a very positive move. And the reason that this dovetails really well into venture capital schemes, a lot of the conditions that you have for qualifying company also apply to SEIS, EIS, and companies which are qualifying holdings for VCT purposes. So I think the challenge with the budget, there was not many business tax measures. So I'm using this as an opportunity to go through the VCT schemes and venture capital schemes, which are in broadly three categories. So you've got the seed enterprise investment scheme, the EIS scheme, and the venture capital trusts. I've been advising on EIS for over 20 years. I enjoy advising on EIS, but also there are lots of challenges in making sure all the conditions are being met. Also, I've been advising on SEIS since it's been introduced in 2012. And these are really reliefs that then we are really trying to push a lot more awareness. We are part of the Enterprise Investment Scheme Association. We do various presentations. And there is still a lack of knowledge about how beneficial it is for founders, possibly, also for investors, and really to help grow companies as well. And I think just to remind everyone, the reason SEIS is great is it deals with that funding gap for a lot of businesses starting up where they can't get traditional forms of financing. Means that investors putting money into a business get a 50% income tax reducer. An individual can invest up to £200,000. And after 3 years, you get the CGT exemption, which is really very valuable. And I think this is something that founders can also think about if they're putting meaningful sums and the right conditions are being met in terms of connections. Also, there are deferrals. So if people have made other CGTs, they can defer the gain into SEIS and EIS. And after 3 years, you effectively get that CGT exemption. The deferral comes back into charge. Only 50% of it comes back into SEIS. You also get, I mean, these are early stage businesses. You also get CGT relief, but the useful thing is the share loss relief, which you can set against income tax. And you've got business property relief as well, which is still valuable, albeit it's been really cut down from 6 April next year as well. There's a slight reduction in EIS to 30%, and the amount that you can raise is up to £1 million. And again, after 3 years, you get the exemption, the income tax relief is held, and effectively there is some deferral as well. So I think the best way to do an example is, let's assume you've got someone called George, they've got income of £100,000, and effectively after tax, going through all the personal allowances and various tax bands, they've got a tax liability of 32,460. If they invest £50,000 into EIS, that's £15,000 taken off their tax liability, reducing it to 17,460, potentially getting a refund. If they've already paid that tax through PAYE. SEIS, even more generous, it's a 50% increase, so that's 25,000, so the liability is reduced to 7,460. And for VCT, that amount's been reduced down to 20%, so that's £10,000, reducing the tax liability. And the reason we're sort of saying that when you're starting up the business, really, I mentioned about the funding gap. If you've got the right conditions and you're, I think, ideally having a conversation before you incorporate a company, if the founders are looking to put a meaningful sum into the business, then they can also claim SEIS relief and EIS relief. And after 3 years, they'll get the CGT exemption, which is much better than the 18% on the business asset disposal relief or 24% with the main rate. There was actually a case where there were 3 professors from Oxford University and they subscribed for £300 worth of shares, and HMRC challenged the position on the basis of how can you justify the £300 as meaningful sum to help with the growth and development of the company. HMRC lost that case. So now I wouldn't go recommending that you put a small sum, but a lot of businesses will, a lot of the founders will put meaningful sums, but you have to be very careful in terms of numbers of founders. You're looking at the connection test, looking at the remuneration, because there are so many conditions on SEIS and EIS that you have to be very careful with. In terms of, conditions, there are lots of, there's 3 typical areas that you have to look at. You have to look at conditions on the issuing company. You have to look at the conditions on the investors. So that's not only the founders, that's the investors coming on board. And there are also general requirements in terms of the limits and all those various things. So one of the announcements, which is very welcome, is that the maximum amount of investment has been doubled. So that's the points in red. The annual amount on a 12-month basis was 5 million. That's been increased to 10 million. And for knowledge-intensive companies, that's been doubled from 10 million to 20 million. And the maximum that you can raise previously was 12 million and 20 million. That's been increased to 24 million and 40 million as well. And the gross asset test as well has been increased. So that's really welcome news. The biggest challenge that we typically have is the maximum age of the company. So I think that's one of the areas that I think ideally over the next few years, we'll see a bit of extending, because it's causing a lot of issues where you have established businesses, they have some good ideas, they're looking to seek to get investments, and the age of the company does present quite a lot of problems. And then typically we work across business tax, employment tax, and private clients. So once both myself and the employment tax team have gone through the SEI/CIS process, we typically then pass on to our private client team to then decide what's the best use of doing the relief. And then I'll pass you on that note to Stephen to carry on with the private client aspect. Thank you.
Thank you, Jan. So it's no surprise the budget, it just took over so much speculation that actually when the budget arrived, for me at least, it felt quite flat. But we have to remember this is quite a big tax raising budget. So why is it that despite all those measures that they've announced, it actually felt quite flat? So it's probably quite helpful if we just go through what was rumored and then what's the reality and sort of take it through. So the first big rumor was actually was she going to raise the income tax rates, or was she going to be a bit dishonest and do it stealthily? Because let's be honest, by freezing the income tax rates, the thresholds, that is an income tax rise. It's just not so transparent. So maybe they haven't broken their manifesto pledge. We did do a slide that looked at, you know, if they'd stayed sort of rising with inflation over the last 10 years, where would we be? But actually, I'm just going to skip over that because that's quite depressing. So, so if actually I just concentrate on the OBR's sort of chart, which, you know, essentially highlights the impact. So the blue line is what the tax receipts that they're going to get from this. That's quite interesting to see actually how much more they are going to get. But then also importantly, with the coloured charts, it shows how many new taxpayers there's going to be in the system. And then more importantly, how many are going to kick over into the higher rates. And I think by 2030, they think it's just going to be under 1 million, which is quite a substantial change. In that, particularly, it's those that are hit by these sort of anomalies, these horrible thresholds. So with child benefit, for example, if you earn between 60,000 up to 80,000, that's when the child benefit gets clawed back. And as we probably all know, when you reach 100,000, that's when your personal allowance gets abated. So for example, in that threshold, 100,000 to around 125,000, your effective rate is 60%. So you go from a 40% tax rate to a 60% and then down to 45. So it's quite unfair in that sense. So what do people in that situation tend to do? Well, they tend to do salary sacrifice, particularly around pensions, because then they get the benefit that they're not in that horrible threshold. But then they also benefit for the longer term with their pensions. So it's not surprising that there was lots of rumours about salary sacrifice, particularly around the pensions, because from a government perspective, it's quite an expensive relief. What I'm pleased to say is that they didn't do quite the drastic measures. And actually what they've done is this sort of reduce their national insurance contributions benefit. So with salary sacrifice, currently, if you sacrifice your salary, pay it into a pension, you save national insurance contributions, and so does the employer. Typically, the employer then helps by sharing some of that savings, so increasing your pension contributions. However, it's some time away, April 29. What they're going to do is they'll only give you relief for the first 2,000. And 2 is quite an important number in this budget. You'll see a bit later that a lot of things are with the number 2. But essentially, over and above the 2,000, that's when national insurance contributions will apply for employees and employers, and then just makes it for salary sacrifice whether that's still beneficial or not. It still works for income tax, so it's only national insurance contributions, so it's a very narrow provision. Just sort of illustrated the cost. It doesn't seem in this example that there's that much cost difference, but if you imagine this is for each individual, combine it, then that's going to add up. And then we just talk from an individual position. It does depend on your salary and how much you actually sacrifice into your pension to understand what the actual impact is. Then we move over to investment income and dividends. There was some rumours that they may increase the rates on dividends more in line with the main rates, which are 20, 40 and 45%. The reality is that number 2 again, they've raised the basic and the higher rate by 2%. They've left the additional rate at that level, so that's unchanged. So it makes a dividend for the basic rate still quite attractive. The higher rate individual, it's not as attractive as it was, and it is much closer between that to the additional rate. They also looked at savings. It was well signposted about the reduction to the limits for a cash ISA. That was well signposted, so that wasn't a surprise. What was a surprise is they put 2% on each of the basic, the higher, and the additional rate on savings income, and that comes in April 27. I should have mentioned the dividend. That's much sooner, so you've got up until April to start thinking and planning ahead of that. With the savings, you've got a bit longer. Then there's the property, and property seems to be quite a favourable way to put more measures on. And because of that, there are lots of rumours about mansion taxes, for example. I will touch on that. But what is surprising is they've created a new property income tax rates. And again, that's higher than the normal rate. So it's at 22%, so it's 2% higher than the normal rates, 42%, and for the additional rate, 47%. So this seems to be another unwelcome change for landlords. Many have probably already exited, not just regulatory, but from the tax. Mortgage interest relief has been restricted. For those with furnished holiday lets, BADR, business asset disposal relief, was sort of restricted as well, taken away. So it all leads to being property isn't probably as beneficial, maybe, particularly for those who aren't the sort of professional landlords. That does look to only apply in England and Northern Ireland because of the devolved, for example, the Scottish and Welsh Assembly. I put for now because who knows, I don't think they're likely to want to be lower than England and Northern Ireland. But that does create extra complexity, particularly for us. I'm sure there's not that many violins for us, but I think it leads to about 15 different tax rates. So that makes more complexity. So much for simplification. Then the closest bit to the mansion tax is a high value council tax surcharge, and that is April 2028. Again, the magical number of 2, so that's but 2 million. And essentially there's 4 bands. The lowest starts at 2 million, and then over 5 million, it's 7,500. It's again probably going to have an impact on the property market. Again, probably aimed at landlords because it's the owner of the property where this falls, not just the person who's occupying it. So tenants, for example, I don't think are expected to pay this, although obviously that may increase rents. My only real comment on this is that typically with property, you get sort of taxes introduced, and they're normally at a high level. However, these thresholds tend to get very slippy, and before you know it, for example, in the annual tax on envelope dwellings that started at around 2 million is now 500,000. So that's just my word of caution on that. A capital gains tax, there are lots of rumours that they're going to increase the rates, there's going to be restrictions, and then even latterly an exit tax. I'm pleased to say they haven't increased the rates. That would be, from my perspective, quite embarrassing because they only increased them last year. So it seemed that they'd got it wrong. And importantly, there's no changes to main residence relief. There was the fear that where you had a property, for example, over 2 million or 2.5 million, that the private residence relief will go. That hasn't happened. And importantly, there's no exit tax, probably because it wouldn't have had the effect, because as soon as they start mentioning it, we got lots of inquiries about people leaving the UK and making sure that happened before the budget date. As Yen has touched on, though, there has been a change in the EOT. I don't need to sort of expand on that. And then that gives us the inheritance tax. And there's lots of rumours about inheritance tax, as you've explained. Some bad, where they expected that there'd be tightening reliefs, such as the 7-year window for potentially exempt transfers. There's the fear that that would be extended to 10 years. There was fear that there was going to be a lifetime allowance, a bit like in the US, but probably not as generous as the US. And then also the regular gifts out of excess income, very valuable relief. There was fears that that would go. And then on the more positive side, there was a fear, there was the hope that there'd be a relaxation of the APR and BPR with talk of potentially thresholds rather than being the 1 million where you get full relief, it'd rise to 10 million. With hindsight, that seems quite fanciful. It's a shame, but there we go. So the 1 million APR BPR cap remains, just like income tax. The thresholds are frozen, and the sort of slight anomaly on that is that the 1 million threshold is meant to rise with indexation. That's being sort of frozen for an extra year, I think, in effect. The good news, though, in inheritance tax is that we don't have to do some really complicated planning just to make sure everyone secures the 1 million full APR, BPR relief, because any unused APR, BPR relief an individual has, that can transfer on death to their surviving spouse or civil partner. That wasn't originally in the sort of the rules, but I'm pleased to confirm that that actually has made things much simpler and is, to be honest, much fairer. There's a small sort of on the non-resident companies, just where people are looking to who weren't fully exposed to IHT, so their offshore assets weren't exposed. They look to do some planning to put that within a non-resident company and then change the status of the asset. That won't work. So you know, essentially, they're tidying up. They're looking at all the loopholes. So the important thing to do, I've spoiled it just like the OBR, is that don't overlook there are other aspects not announced in the budget, and that's making tax digital. That is coming. I know we've been saying that for many years, but that is coming. That's not going to be deferred. Sadly, that will start from April 2026. And it starts off at a high threshold, and then gradually over the years will get lower, because essentially for sole traders and landlords, they're looking to make sure that you file quarterly. The threshold is based on the 24-25 tax returns. So essentially, it looks at your previous finalized tax return to see if you meet those thresholds. And as I say, you've got to keep digital records, and you have to file quarterly with an end of year period statement and final declaration, which will, I think, replace the tax return in due course. Now, some people get quite excited, so I do want to make this point. There are only limited exceptions for those who are truly digitally excluded. So whether you try and pretend you're not really capable with the digital, I think essentially if you have an email address or a smartphone, you're pretty likely to be in that. And unfortunately, as one of my clients, he's only got a smartphone so he can pay for parking now with the app, that's going to be bad news for him in that sense. So just be aware of that. And I do realize that essentially with this budget, there's not a big bang. There's not a big sort of tax windfall. It's a lot of small measures. And so I thought it's quite helpful if we just put a sort of a timeline of the main ones, just to show how they come in and sort of the impact that they'll have. It's already been noted that the tax increases are sort of backloaded. And you know, for the cynical, it could be because an election, I think the last it can be is around 2029. So it's quite good for the government that they can do a pre-election giveaway, especially if it's a tax that's not actually been introduced. So they can set it as a tax cut, but they're not actually cutting any tax. They're just changing the position. So I think, in conclusion, the important thing to note is that whilst it felt quite flat, some of that was because they allowed, or maybe they weren't too sure in the speculation, things to run away. So it seemed like they were going to do some very drastic measures. They haven't, but what they have done is quite clever. They've spread it. That 2%, I think they must have got some research on something like that, because the 2% is, or the number two is everywhere, so it doesn't probably feel as much. But I think as a combined, in your pocket, you're going to feel that actually those 2% they add up, and actually what's in your pocket is not going to be as much as you thought. So with that, I think it's a good time for me to hand over to Sancha. He's going to help you understand the practical impact of the budget on your personal position. Thank you.
Okay, good morning, everybody. It's really nice to see you all, particularly when there wasn't very much to listen to in the budget. We were quite concerned there might not be very many people here. So it's lovely to see some familiar faces. I'm not going to say old because that makes me feel old, but familiar faces, and those who are new to us as well. You're all equally welcome. Fantastic presentations from Jan and Stephen, giving us something to think about. And as Stephen has just said, I'm perhaps going to put a bit more flesh on the bones of that. The devil, as they say, is in the detail. And while they leaked the OBR report early, they put the brakes on the detail. And it was quite some while and quite uncomfortable on Wednesday that the detail wasn't available to us. We don't know if that was deliberate or if it was just an additional error from the OBR, but it wasn't the smoothest of days, shall we say. So this morning, checking where we are, we're going to be talking about your personal position. So how does this all impact for you? I'm going to start by looking at personal assets, then look at business assets, and consolidate at the end with some planning opportunities. So starting with the personal assets, in this section, it's pretty obvious. We're talking about anything that isn't a business asset other than your home, which is very difficult to plan with unless you're downsizing. If you're one of those people who's downsizing because of the new council tax charges, do come and talk to us, because you're probably going to need some PRR advice as well. So what personal assets do people have? ISAs. ISAs are going to become much more relevant because they are free from income tax, they're free from capital gains tax. The amount that you can put into it hasn't really been restricted, because anyone who's got significant ISA portfolios will know they don't keep it in cash anyway. They have stocks and shares. So the changes probably won't impact most of the people in this room. But what is often forgotten is it's free from income tax and capital gains tax. And most clients assume it's also going to be free from inheritance tax. And I get lots of disappointed faces when I say no, that is fully taxable, but we've been building it up to pass it on free of tax. It doesn't work like that. We're also going to talk about restructuring portfolios and whether there's anything you can do to improve your position. So why do we need to do this? Well, Stephen has already stolen the news. There's an extra 2% tax that's coming in on savings. And if that isn't breaking your manifesto promise of no income tax rises, I just don't know what is. 2% is 2%. We're going to have to pay it. So on dividends, it's going to change some calculations we're doing. Should you extract profit by way of dividend or bonus, it will impact that. But for your property income and your savings income, that extra 2%, and this is the same slide that Stephen had earlier, 2% is 2%. You're going to have to pay more. It's going to hurt your pocket. So we want you to talk to us because there are opportunities that are out there. Is it, for example, possible to speak to your IFA and your stockbroker? We like to work together with these people all of the time because you can restructure portfolios to generate more capital growth rather than income. And if income is going to be taxed at these higher rates, I'd rather have less income and more capital growth and draw on that. I don't care, so long as the cash is in my pocket, whether it is capital or income. And that's quite an interesting set of calculations. So this is not a real scenario, but it helps to have the same numbers. So if you were taking dividend income of £20,000, your net cash, after all these rules are coming in, would be 13,000 and a bit. Now let's assume you bought a share and you paid nothing for that share at all, which is obviously not how it works, but let's assume that you did, and you sold it and you have a capital gain of £20,000 because you've got no base cost, so it's pure gain. If you sold that, the cash in your pocket would be £15,290. Now that's quite a big saving, isn't it? Bearing in mind that most of you actually, you wouldn't be cashing it in for £20,000 and that would be the gain. You might be cashing it in for £20,000 and the gain might be only 6 or 7. And then the cash effect is much, much more pleasant in your pocket than the income tax situation. And it's exactly the same if we're talking £200,000. There is a big, big saving. There is a difference between capital and income. We've been talking for a long time with many clients about how is your portfolio structured, and lots of people in the audience know this far better than I am. But you can restructure your portfolio so that it has capital growth in it rather than focusing on generating income. And particularly if you're starting with a pot of gold today and you haven't already got a portfolio that needs restructuring, you might be looking to say, well, actually, should I structure this for capital growth and just draw against it on an annual basis? The tax saving is quite significant, and I would be very interested. Take advice, speak particularly to your IFAs and stockbrokers as well as us as tax advisors, because what we don't want to do is restructure a portfolio and generate a massive tax liability to do it, because that would be a real shame. And then there's a different way of looking at your investments overall. Should your personal investments be in your personal name? That's traditional, it's comfortable, we know how that works. But would it be better to do it differently? And if you did, what would that look like? So effectively, we'd be talking about holding your personal investments in a company. We call them a family investment company because we like to use them for planning, because they're flexible, because you can have a structure that enables you to bring other people in, your children or your spouse or wider beneficiaries if you choose to do that. But you can keep control of it in a way that works for you and share the income and share the growth. And maybe if we do it properly, you might not even have the growth in your portfolio that's going to be charged to inheritance tax. So family investment companies, we've been talking about them for a long time. I like to think they could have anything in them, but quite often they have properties, quite often they have cash. There are opportunities for existing businesses that are investment focused. So talk to Jan, particularly as a starting point, about how we can restructure and what we can do. But if you're in a position where you've got investments in a company, we can look at alphabet shares. We can have A, B, C's and D's, and we can decide we don't like the shareholder of D and they are not having any dividends this year, if that's how you feel about them. Or you can say, actually, my wealth is enough. I don't need any dividends myself, but I do want my children who are at university to be able to pay for their own university costs so they can have dividends, because that's really tax efficient if they do that. Don't want to increase my income. So we're using it carefully for spreading the family wealth around. And you can do it more widely as well for inheritance tax. And usually we have properties in these businesses for, but it could be any investments. Mum and dad have a company, let's say it's worth £4 million. Now, there are those here who know this as well as I do. You have to have a hurdle. I'm going to ignore the hurdle today for anyone who knows what that is, because it just makes it too complicated. Mum and dad have a company, it's worth £4 million. It's going to keep growing because that's what property does. That's what investments do if they're well managed. And let's say in 10 years' time, in 2035, it's going to have doubled in value. So today, 1.6 million is what's going to be payable for inheritance tax if the number 7 bus gets you on the way out. But by the time it has grown, and assuming IHT rates stay the same, you could be looking at £3.2 million worth of tax in mum and dad's hands. So what do? We say, well, actually, mum and dad don't need that money. They don't need that growth. All they're going to do is pay inheritance tax on it, or we are when they're dead. So what we're going to do is we're going to have some growth and freezer shares. We're going to freeze mum and dad's value at 4 million. They can never have more than 4 million. And actually, sometimes we even look at it and say, well, should we fix it as 4 million and let them draw against it to reduce that figure? It depends on the circumstances. But what we're definitely going to do is we're going to ring fence and capture the future growth, that next £4 million that's coming. And where are we going to have it? Outside mum and dad's estate. We don't pay inheritance tax on it at 40%. It's an investment company. It's not going to get any reliefs. So let's capture that growth outside of the estate. So we set up a trust, or we could make direct gifts, but we're going to set up these nice growth shares that have very little value now. They have to be valued carefully, but at the moment they have very little value. So you can give them away, no capital gains tax. You can give them away, no inheritance tax. But as they grow, they're already given. And that growth is outside of the estate, in the trust or in the hands of the individuals. However, we have structured it for you. It's a really good thing to think about particularly in this age where inheritance tax reliefs are coming down. So we like to look at this with our clients and say, what do you need? Where is it going? And as we're talking about companies, let's talk about business assets. It seems a sensible thing. So what are we going to talk about this morning for business assets? All of these things on the screen. Profit extraction, what should you be doing? What is your journey? Are you heading for an exit, or are you heading for a succession, family succession? Hopefully, you've structured your asset up front and in the correct way, as Jan was talking about earlier. Did you miss the boat? We'll get to that in a minute. We'll be looking at that capital growth again, because all businesses, not just investment business, have capital growth. And what can you do about them? So profit extraction. Now, historically, this was really easy for us as accountants. We said, take a salary equal to the national insurance lower earnings limit to protect your state pension. Take the rest as dividends. That's what we did. But that doesn't happen anymore because it's much, much more complicated. And I'm not going to tell you what the answer is today, because the answer, it's my favourite tax answer, and I always like to use it at least once every budget presentation, is it depends. It depends on you and your circumstances. It depends on the profitability of the company. It depends, do you want to make pension contributions? It depends on the cash requirements of the individual. It depends on cash flow in the company. If you pay a dividend, for example, the tax isn't going to have to be paid over to the Inland Revenue for at least a year, maybe a lot longer. If you pay a bonus or salary payment now, you're going to pay the PAYE. So cash flow comes into it as well as saving taxes. And then you've got the complications that you might well be an entrepreneurial, very developing business, and you've got R&D tax credits. And Jan's going to say, stop, don't pay out dividends because we can get the PAYE back. So your circumstances and what your business is doing and what you need is going to drive the answer. And there is no simple decision on profit extraction these days. We need to look at it much more closely than we ever have done before. There isn't a standard answer. There's just the right answer for you. So exit or succession journey, where are you? And what are you doing? Because it might be slightly different if your plans. I always like to say, if you know where you're going, you'll end up in the right place. If you don't know where you're going, something could go horribly wrong. So as you know, I'm rubbish with IT. And I put into my sat nav at Newport, because I was going to Newport, and it said 3 hours and 40 minutes. And I thought, I know CB1 traffic is really bad at the moment. But, you know, Saffron Walden's not that far away. It was taking me way, way, way over into Wales. If you don't know where you're going, you'll end up somewhere else. So it's looking at it and saying, structure that asset correctly, get the outset just right at the beginning. If you're looking to incorporate, please talk to Jan, particularly any of us in the room, because we can help you structure it right. If you didn't do that, because quite a lot of businesses, and let's face it, cash comes into it, they say we just haven't got the time, or the money to take advice now. We're just going to get going and do it. If you missed the boat right on day one, still talk to Jan, because there's something he might be able to do, because these opportunities, as you said earlier, are for scale-ups, not just for startups. So it's always worth having those conversations with us to see where we can help. And for me, that's what this budget's about. There's been lots of tinkering, lots of little changes. It's important that we know where we're going and we're taking the right advice all the way through. And then I wanted to talk to you about capital growth, because as I just said, all businesses grow. Hopefully yours is a really successful one and it's going to grow a lot. If you're going to do some planning, we need to know now with absolute certainty what that business is worth when we do the planning. So what is it worth today? More importantly, realistically, what do you think it's going to be worth in 5, 10, 15 years' time? But whatever planning we do, whether we're looking to structure you for alphabet shares, we're looking to structure you for freezer and growth, whether we're just looking to the future and saying, is this tax efficient? Have you got enough people involved? Is your spouse holding shares? Things like that. We now need to know what is the value. If we're claiming agricultural relief or business property relief, we need to know what we're playing with, because if you get the valuation wrong, your relief could go horribly out the window. We'll talk about that more in a minute. So I thought it'd be a really good idea to introduce you, in case you haven't met them yet, to our corporate finance team. Some of them are hopefully in the room and will be out there later today. They do business valuations, and if you need that certainty, they are the people to talk to. Slides will be available electronically later, so if you don't know these people, please feel free to look them up and have a chat. So planning, what opportunities are out there for us? How are you going to be impacted by the new rules? I want to start by recapping, if you don't mind, because the rules that came in last April, they have tinkered with a little bit. Sorry, came in last October for this coming April. They've tinkered with a little bit, but there's still what we like to think of as a great window of opportunity. This is your time. If you've got business assets, agricultural assets, we can plan with these, and a lot of people in the room are going to be very, very busy between now and the 5th of April. So we've got a new 1 million cap, which is shared between your agricultural and business property reliefs. It can apply to your lifetime gifts and death transfers and trusts. More on that in a moment. The cap is £1 million for 100% relief. Remember, you still get 50% relief afterwards. So it's not great. It's not as good as it is at the moment, but it's not terrible either. So what does it really mean? Let's look at Rachel. Rachel has a home. It's worth £1 million. She's under the limit. She's okay. She's got a life interest trust, an old style one, worth about 2 million. She's got a lot of business and agricultural assets, 5 million each. And she's got a pension worth 700,000. So you can see on her balance sheet here, her total assets, £13.7 million. And at the moment, because of the exemptions, today, if she was to be hit by the number 7 bus, she's going to get 100% relief on her 5 million APR assets and her 5 million BPR assets. So the tax she's going to pay on 13.7 million is really proportionately reasonable, I think. So after tax of just under £1 million, she's going to have 12.7 left. I think that's not bad. But, and I've put April 27 on here because I just wanted to bring the pension into it, but the biggest rules on it are from this coming April. The position is going to be very, very different. She's not going to get the same level of generous reliefs on her agricultural and her business assets. So she's going to pay, at the moment, just less than £1 million, and in April 27, just over 3. That's quite a big increase. So what can we do for Rachel about that? Now, I'm just going to start by saying I'm not going to give you an answer today, because I don't know very much about Rachel. I don't know how old she is. I don't know if she's in good health. I don't know what her other arrangements are, all of which we have to look at. But for example, I had a client come and see me very recently, and a couple, they sat down in front of me and they said, we know what you're going to do. My son's told me you're going to tell us to put all of this into a trust. I said, great. Should we start at the beginning? Let's take a few steps back, because for the clients I had in front of me, that would be the worst thing to do, because they weren't as young as I would like them to be if I was giving them that sort of advice. If you're young, great, stick the shares into a trust, that's fantastic. It is likely that planning will work. This couple were not young, and he started by telling me he just had a stent put in his heart. And I'm thinking, is he going to make 7 years? Because there's lots of nasty anti-avoidance that lots of people don't know about. But if you put something into a trust and you are not here in 7 years' time, there's a huge clawback of the relief that you had when you put it in. So you put the shares in now, claim 100% relief, but that whole gift is re-looked at should you pass away. And if the new rules are in by then and you don't survive 7 years, you'd end up paying tax. So everything is bespoke, is I suppose the message I'm trying to give you today. It might be for Rachel that we would talk to her about putting some shares into trust. We might talk to her about having freezer and growth shares. All of that could be very relevant, mixed in with lots of other opportunities for her. But until we've sat down and looked at her personal financial position, which we would do when we're creating these balance sheets, we can't give you an answer. So a little bit like extracting profit, it's not straightforward. There's an answer for you. Stephen's already told you we can transfer the relief between spouses on death. And the point I wanted to bring out there was, even if the spouse had no business assets herself or himself, you can still take their relief. APR and BPR for trusts. Now, I've put on here, these are very complex. These are horrible rules, frankly, and I'm not going to go into a lot of detail, but simplifying it as fast and as easily as I can, there's a £1 million cap where you get 100% relief. If you have a very old style discretionary trust and that existed at 30th of October, you'll get that relief. Even if you hardly had any business assets at all, you'll still get the £1 million. If you had an old style qualifying interest in possession trust, also at that date, but a much older trust, you can share that £1 million with the life tenant. Can't choose how you're necessarily going to share it. It's going to be based on a prorated basis of who's got what business assets. So that feels a bit harsh sometimes to the life tenant. But when it comes to new trusts, these are really, really complex. And to summarise it, the amount that goes into the trust, the settlor can claim relief on. And if the settlor can claim £1 million worth of relief, it is likely the trust can also claim £1 million worth of relief. But if the settlor has already used his £1 million up, or nearly, and puts in £10 of, well, he'll put in a lot more assets, but only £10 qualifies for relief, the trust will only get relief for £10 of assets. So again, it's really complicated. Keeping records is going to be absolutely imperative. And if you've got one of these trusts, we need to look after it really carefully. Our trust team are also here. Simon Harmsworth, sadly, is not today, but he is the person who knows all the technical ins and outs about these trusts. And if you've got one or a question, please do talk to Simon. So what should you do now? I've just realised I've got 1 minute to tell you about this. So what should you be doing? You should be reviewing your position. Talk to us, talk to your IFAs, talk to your stockbrokers, talk to your bankers, talk to your lawyers. We need to be reviewing your circumstances because things have changed and are changing quite significantly that will affect structuring we've put in place in the past. Let's do a personal asset balance sheet. Let's have a financial health check. Let's look at, have you got excess income? Have you got excess assets? If you've got no business assets, could you get some to get your £1 million relief each? Everything's going to need to be looked at. So what are your strategies for pensions, lifetime giving, excess income? Do you want an FIC? Do you want to minimise inheritance tax? Some people don't care if they pay inheritance tax because they don't. It's payable by your estate. So we have to understand what is important to you, and that will help us structure where you should go for the future. Historically, we used to say, well, maybe look at these every 3 or 4 years, or if something changes in your life. Actually, now we've sat around the table and decided you should do this annually, at least. You need joined up advice is absolutely critical. We work so closely with all the other professionals to make you get the best solution for yourselves. You need your lawyers, IFAs, bankers, solicitors, stockbrokers. Let's get it right. The best solution for you is what we're looking for. You need a bespoke position, what is absolutely right for you. Your situation is unique. I've just given you an example of a client having been told by his son what he was going to do. It's not what we're going to do. Don't listen to people say down the pub. Don't Google it or chat GBT it, because that can give some very interesting answers, which won't be right. Please do talk to your professionals. We work together to get the best solution for you. I'm probably going to draw towards an end, not quite yet. But I wanted to thank you all for being here today. You've sat really patiently and no one's gone to sleep that I can see or hear. So we're going to let you go very shortly, but I did want to thank our team, because this is a team effort, the budget presentation. It's not just the 3 of us. We have the rest of the team help us prepare them. A lot of them are here today. We have 72 advisors in our tax team these days. It is a constantly growing team, and I am told that people don't know that. So here you go. These are the team, all 72 of them. Whatever your circumstances, it's unique to you. Let's get you the right advice, and let's get it done sooner rather than later if you've got something that needs to be done before April. And at that point, I'm going to say thank you very much, and questions and answers to Warren.